All right, welcome everyone to the New York Alternative Investment Roundtable's current event, Asset Allocation and COVID-19. I'm Erica Tunick, Director of Operations for the Roundtable, and we're glad you're able to join us today. Before we get started, I just want to take a moment to thank our sponsors. We are very thankful for their continued support and wouldn't be able to do this without them. Now, just a few logistical issues. Today's event is being run as a webinar. While this unfortunately means you can't see the other attendees, it's the most secure way that we can hold our events, but we still want your participation. So if anyone has a question, you can ask it through the Q&A button at the bottom of your screen or through the chat function. And now I'd like to get on to today's afternoon event. We're happy to welcome Henrik Lumholt, author of Strategic and Tactical Asset Allocation, an Integrated Approach. Henrik will be outlining the key principles of his investment approach, explaining how and why many of them challenge conventional thinking about asset allocation. Henrik is a partner at investment advisory firm Copenhagen Allocation Partners. His previous roles include Chief Investment Officer of Spain's largest asset management company, BBVA AM, Chief Economist for Bank of America Spain, Head of Fixed Income Research at FG Merrill Lynch, and Senior Economist for Nordea Bank. He has been an adjunct professor of economics and finance at IE Business School since 2001 and has won numerous prizes for outstanding teaching. Now I would like to hand things over to Henrik.
Great, thank you so much. And thank you so much to the New York Alternative Investment Roundtable for organizing this event. I've known BJ for a long while because we actually were colleagues back at Bank of America, but I'm glad we could take up the contact again and do this event. And very welcome to all participants. So as Britt was saying, there are some sort of two blocks here in a way. I'm going to start off with what I call some asset allocation tenets, the sort of major beliefs that I have and which are expressed in the book, and then zoom in on concretely on the four-phase framework, which deals with tactical asset allocation. I'm going to try to apply that framework to the situation right now and see what insights we get from this. And of course, what exceptions from the empirical data, what exceptions for the historical data that we have at the moment. I'm going to glance through some of the major asset classes for points on current valuation, situation, with positioning, etc., and then round off with some asset allocation ideas more generally. And then finally, I'll round off with some general ideas, the takeaway on asset allocation that I get out of all this. The first tenet is that I don't believe the active versus passive debate applies to asset allocation. And that's important because I think a lot of people still think that somehow the strategic asset allocation, which I call SAA, is some sort of passive alternative. I don't think this is correct. I think this is an illusion, to be honest, because even though the SAA is static, it's loaded with decisions, and we don't really have a benchmark for the SAA. We really need to have a benchmark for it to be objective, but there is no benchmark for the SAA, and hence there isn't really an objective benchmark for the TAA. I mean, if for in-house purposes, it's practical to compare your TAA decisions with your SAA, but don't go too far because I'm not so sure that it really means very much. And put this differently, there's really no way around asset allocation. When we get to that level of decision, we have to make decisions. There is no passive approach. Another, I think, conviction among some people is that somehow it's easier or even safer to do SAA. I mean, the decisions on which they're based are somehow safer or clearer and less guessing than TAA. I'm not so sure this is true. If you look at what we put into the SAA, of course, the first level is trying to predict longer term returns, but we also, and then we move on to use portfolio optimization techniques, which are obviously more relevant at the SAA level. But the problem is that the all the critiques of the assumptions in these models does apply. There's a constant level of risk, constant correlations, normally distributed returns, et cetera, et cetera. I think the biggest problem is the correlations. Some SAAs somehow have built-in assumptions about diversification effects. And I think the empirical fact is that we've seen this fail several times. The outbreak of COVID-19 was an example. Normally, we have seen government paper, especially, of course, long-dated government paper, do very well in recessions. It didn't really happen in COVID-19. And probably the main reason for that is that we had already very low levels of interest rates. But the problem is that this assumed built-in diversifier didn't really work. Risk becomes regime dependent, and there's really no way around the shorter term view. How about longer term returns? Are they more predictable than shorter term returns? Well, on some levels they are, but on others they're not. I think valuations are much more helpful in the long run, but we still have the problem that they have to mean revert within a time horizon which is relevant for us as investors. So if my time horizon is 5 years, it's going to happen over 5 years. Is it going to take 10? Or if it's over 5 years, or my investment horizon is 10 years, what if things go even more extreme or go into the opposite? It's very difficult to trust that valuations come back to what I think are fair valuations over a given time horizon. I still think it's true that valuations are helpful and much more helpful in the longer run. But still, there are caveats to this. Another thing is the relationship between economics and the performance of stocks, to put it broadly, is not so clear over the longer run, which is actually a bit paradoxical or counterintuitive, because if you look at longer term growth rates in the economy and the performance of stocks, we've seen a bit of everything. The latest period we saw after the great financial crisis was one of relatively mediocre growth, for example, in the United States, and splendid performance of stocks. But by contrast, when we take the shorter term view, obviously we're going to look at the cycle. And ironically, the relationship between the cycle and the performance of, for example, stocks, but most risk assets is much clearer. I'm going to get back to the cycle because this is very much about what we can read out of it. But just an observation here is that it's true that cycles don't repeat. I've taken a quote from Mark Twain and changed it a little bit, but I do think they rhyme, meaning that, of course, there are patterns that we can identify over the shorter run. To be a little bit provocative for the SAA strategist, looking over the next 10 years, what is the answer to these questions? Will we get secular stagnation, Lawrence Summers' thesis? Will that reimpose itself? Because it did look like we were getting more and more sluggish in average growth rates. Or will policymakers start making experiments such as the ones recommended in modern monetary theory? On the other hand, is there a limit to how indebted developed markets economies can get before something happens? I don't think anybody knows what the limit to indebtedness, public indebtedness out of GDP, where the limit to that is. And it's not really very clear what happens when we reach it. So this is an open question. But how about all the good things that happen to technology? There's so much progress and we learn new things all the time. Could this, on the other hand, become a positive scenario and we end up getting much better productivity gain? We haven't really seen that happen yet. So there's a strange contrast between what the macro readings are and what we see in the actual businesses. Then there's the question of globalization. We're all tracking that. Everybody's following what's going on in China, for example, right now, which looks somewhat concerning. Is this setback we have right now, is that just a short-dated one, or is that a precursor to a longer-term trend? I don't think anybody really knows, but some people's guesses, I'm sure, are much better than mine. But my point is here, I think we cannot stop paying attention to new trends while they're in the making. We have to follow the shorter term. So what about the cycle, which I already mentioned? Well, a point about that is that The classical way of looking at the cycles, of course, is really just expansion and contraction. We have peaks and troughs, and the periods between them are either negative or positive growth. But that doesn't really suffice when we talk about determining the investment climate from a top-down perspective. We need something more. The key point is that growth itself, economic growth itself, follows a cycle. And that's more interesting than the cycle in GDP in absolute terms. And of course, this is what the output gap is about. And this is has been the motivation in the book to his job. We looked at that. The output gap is, as you know, the difference between actual and GDP, actual and potential GDP growth. We're interested in the level of the output gap, and we're interested in the change in the output gap. One paper which outlines macro sensitivities in a very clear fashion was written by Illman and some other people, and they make a top-down framework for macro sensitivities for equities, government bonds, and commodities, and it's delivered in a pretty straight out format. The growth up, growth down, inflation up, inflation down, and combinations of these scenarios. Now, to keep it short, because this will take me too long to go more into detail, obviously, it's not a surprise that equities favor growth up and inflation down. But what is clear here in their analysis is that growth is more important than inflation. And that has a relevance to the current scenario. Bonds like growth down and inflation down, but inflation is more important than growth. And the same applies to commodities, which favor growth up and inflation down, but inflation is the more important variable. Now, how does that relate to the output gap? Britt, is this going through okay?
Yep, you're all good.
Okay, fantastic. Okay, so I'm going to try to relate this framework to what I call the phases of the economy expressed in the output gap. Growth up and inflation down is the typical scenario of what I call phase one, which you could call recovery. So we have a negative output gap, typically also high unemployment, but it's decreasing because growth is higher than its potential. That is the more typical scenario for high growth and relatively low inflation. It might even be a downtrend in inflation that's still going on. High growth is not typically related to inflation with a slack in the economy as we have in the phase one. Moving on, we close the negative output gap and we start building a positive output gap. We've now eliminated all the slack, and this is what you could call the expansion phase, or phase two, as I simply call it. Positive output gap, and it's increasing. Now, in that phase, it's much more likely that inflation will start creeping higher. Of course, it depends very much on how pronounced this positive output gap is, but this is the scenario when we start seeing signs of inflation. The phase three, we peak out on the output gap. It's a positive output gap, but it starts decreasing. In this scenario, growth is down because we're underperforming potential growth, but problematically, inflation keeps being high. And of course, the reason for that is that the economy is still working above its potential. So even though we have a slowdown, we can still have inflationary pressures. And finally, when that has finished, when we finalize growing by less than potential, we eliminate the positive output gap, and we start building on a negative output gap. In that phase, which is of course the final phase, growth is down, but inflation also starts getting lower. So before I get to the performance over the four phases, let me just make a point about the Fed in particular. The framework that I presented in the book was based on US data. I'm sure it's applicable to other markets, but it has been the US has been the best case in point in our research. If you look at the Fed has actually typically tracked the turning points in the output gap, as you can see historically. But when we get past the great financial crisis in 2009, these things start changing. The Fed no longer starts ever so modestly hiking rates when the output gap bottoms out. It actually refrains from doing that, leaves rates on hold, and even ends up cutting them in what I would call a late cycle in 2009, before the outbreak of the COVID. How important are rates for markets? Well, they're obviously incredibly important, but I don't think we should get so far as to say that everything is down to the Fed, because that would be a mistake. The phase we're in is also very important. Now, the typical pattern we've seen when rates have been rising and been raised is that multiples tend to contract in such phases. That doesn't mean that you can't have relatively good equity returns, of course, because if earnings are still strong, the net of the two effects is still positive. On the other hand, if we've received help from lower rates, we even get multiple expansion on top of the support we get from earnings. So moving on to performance over the cycle, the phase one has typically been the best phase for equities. Whether the Fed has raised rates or not has been about 50-50 historically in this phase. So I think the thing to do, of course, is to evaluate each phase independently. But it's typically a phase in which the Fed is not too busy to hike rates, and that helps equities. So they're particularly positive, of course, if we have a rates down scenario. Bonds are pretty binary. If rates are down, it's positive. If rates are up, it's negative for bonds, even though we have a negative output gap. So this is, you could say, the sweet spot of the cycle, the phase one. And as I'll get back to, that is indeed the one we've been in and perhaps are probably finalizing now. Phase two does not have to be bad. It depends very much on how it pans out over time. There are more cases of Fed tightening, but still, if earnings are strong, equities can still do quite well. If we even have help from the Fed, it gets even more positive. Bonds, again, are binary. Commodities are very positive with rates up, and that's typically because there's been some inflationary pressures. Sorry, I forgot to mention in phase one, we typically have a moderately positive commodities scenario. Phase three is pretty much the worst of both worlds. We have falling growth, we have rising inflation. It's 50-50 whether the Fed starts easing typically, but the problem with this phase is that exactly the mirror image of phase one. Equities are most reliably negative in this phase. Bonds, again, binary, and commodities typically do relatively well. And I would call that, of course, the outcome of late cycle inflation. And of course, commodities themselves are actually contributing to that, typically in that phase. And finally, the phase four, which is a bit of a toss-up because it is typically relatively bad for stocks in the beginning, but at some point in that phase, we typically bottom out. So it's harder to say something about the phase in its as a whole, but equities are typically mediocre in this phase. Funnily enough, they have turned out to be positive with rates up, and I think that's because that's typically coincided with a strong recovery from phase four. Commodities, however, are outright negative in a phase four. Now, how about recessions? You might say there's no recession in this framework. Well, the recession typically happens late in phase three or in phase four. And that's what complicates the phase four, because when we bottom out from the recession, it typically benefits stocks. So we get a rebound in that phase. So where are we now? Well, if you look at what the Congressional Budget Office estimates, the latest figure is for Q1. I think they now probably have a figure for Q2 because we just got the GDP figure for the second quarter. Now, that would leave us with an output gap of somewhat bigger than -1%. It's still negative, but it's not so negative as it has been. And it is pretty close to to being eliminated. I would say that if we continue at the current growth rate, it's over over the next quarter, it probably becomes zero. Now, you have to contrast different measures. I don't think there's any one reliable measure on the output gap, and there's a lot of debate about how to measure these things correctly. I think we have to be pragmatic about this in practice. But another measure which is relevant is the so-called unemployment gap, the difference between the actual U rate and NIRU, non-accelerating inflation rate of unemployment. Now, a typical, the pattern is that if you have a positive unemployment rate, that corresponds to a negative output gap. If you take that measure, unemployment is approximately 1.5%, its natural level. I would say that'll take longer than 1 quarter to eliminate. And then finally, a point I thought was very interesting to see, and in an article by some economists from the Federal Reserve at Dallas, they make the point that everybody's measuring the gap that we need to close in employment from the figures that we had just before COVID broke out. But their point is that we actually had what you could call an overheated economy or an overheated job market, because we were at a lower rate, a higher rate of employment to population at that point than the longer term trend. So if you use that measure instead and say, okay, I need the employment to population ratio to get back to normal, the gap is relatively small. They only find a gap of 0.3% negative. So that means we are relatively close to a zero output gap. And that's kind of where I end up in my conclusion. So we're near the end of a phase one. What about growth then going forward? That, of course, is going to be critical. If you look at the growth momentum, I think it still looks very strong on pretty much all forward-looking indicators. But there is an argument for moderation. Of course, the fiscal stimulus will pan out in the second half of the year. If you take the year-on-year rate in growth, you can have a negative base effect. And then, of course, there's the big concern that we all have that the Delta variant of COVID will now prompt new lockdowns, even though we haven't really seen that yet. You can also argue that the higher inflation could dampen consumption at some point. But how strong is this? Well, I think we have to contrast that with the fact that pent-up demand, as you call it in economics, is quite significant still. It's well known that all the fiscal support we got in 2020 and going into 21 created an enormous boost to incomes because they're typical direct transfers to consumers. And we haven't really seen all of that consumed yet. Some consumers have lowered their saving rate and generally, have lowered their indebtedness, but generally the saving rate is still pretty high. And I think this is a cushion for growth. It's difficult to imagine that we're going to get consumers going into reverse gear anytime soon. So I think we're going to have growth above trend, meaning that the output gap will continue to close and get positive. What about the Eurozone in comparison with America? Well, you look at what happened in 2020, EU and Eurozone GDP fell by more than 6% against only 3.5 in the United States. And in spite of this, the rebound that we've had this year has been more muted. I think there are obvious reasons for this. The size and speed of the stimulus programs have been slower and lower. And of course, there's been more concern over COVID-19 in Europe, and the reopening has been slower. But if you look at forward-looking indicators, I think they look very buoyant. And I think there is a case now for a pickup. I'll get back to that. I think the same thing happens to the rest of the world in varying degrees. It doesn't look like when we move outside of the United States that the rest of the world is in stage 2. I think it's in stage 1 still, and it's still got quite a lot to go before we close that output gap. Now, onto inflation. If you noticed, my point about inflation in the phase 1 was that we typically don't have inflation. That's what's typically so appealing about the phase 1. So early cycle inflation is obviously not the rule. So what is going on at the moment, and especially in the United States? Well, I think the standard explanations make sense. We certainly had excess capacity when we started, and we probably still have, but we cannot really bring it to the fore because there are restrictions of all sorts and kinds, transportation, supply chains, sudden changes in consumer demand. We've all heard about the used car market exploding in prices and odd things like that. I think these are very much the expression of COVID. And you could say that commodity prices have added to that. So how much is cyclical, how much is COVID related? Very tricky. But I think most is COVID related because these are extraordinary circumstances. Now, could it get locked in? Could we be so unfortunate that we lock in a high inflation rate and we simply cannot get rid of it again? As everybody knows, or at least economists very much like to say that once the genie's out of the bottle, it's difficult to get back in. Could we have expectations on anchor so that higher inflation becomes self-fulfilling? It's a possibility, but I frankly don't think we need to end up there. We've certainly seen an upward shift in inflation expectations, but I wouldn't call that a structural shift yet. Another factor which is important is that we cannot really see huge wage and salary pressures in the economy. You can take different metrics. You take average hourly earnings, which are very volatile. The latest figure is 3.6% year on year. But if you take the employment cost index, on the other hand, that's running at a rate of 3% approximately. But I do admit, and I do agree that it'll take some time to rebuild supply chains. And especially, of course, with now all the geopolitical tensions, it doesn't make it easier. So yeah, Fed could be right. I think the Fed will be right that it's temporary, but it's going to be pretty stubborn, I think. What about the Fed then? Well, we still have a clearly flexible Fed. It's now targeting average inflation as opposed to point inflation. And that means that we don't get the prompt reaction we've seen in the past, especially before 2009, to the change in the cycle and any signs of inflation. But of course, what does temporary mean? I don't know. I mean, anybody can make their guess, but I try to listen as much as I can to what the Fed actually says. As far as I can hear, when Jerome Powell speaks, it looks like the window probably closes towards year end, because inflation is probably going to be more than 2% by then, which of course is the official target. Now, what does that mean? Well, it means that tapering of the quantitative programs, quantitative easing, will probably commence. But I think we shouldn't get overly excited about this. I think the route back to what you could call normal interest rates, such as what, for example, the Taylor rule would imply, is going to be very long. It's going to take a long while before we get back to 2% official rates. Maybe we even top out at around 1%. And I think the risk of the Delta variant, which is of course a concern in the market, it reinforces the patience of the Fed. What about the ECB? To take another case in point, well, it has an inflation around 2%, an inflation target of 2%, but it's changed the old rule, which was that the target was close to but below 2%. We now allow an overshoot as well as an undershoot, and that means that the ECB has also bought time. I don't think the similarity with the Fed goes much beyond that. It does look a bit like they've taken a leaf out of the playbook of the Fed with respect to the targeting, more flexibility around the target. But I think we have to remember that the cyclical differences are still significant. We haven't even seen inflation go beyond the target yet. So what about when it does? Will the hawks on the Fed, and we all know who they are, will they get more noisy? I think they will, but we've seen that before. I don't think it's going to change the basic stance of the ECB anytime soon. So just a quick look at some of the main asset classes from the point of view of some of the indicators that we like to look at in Copenhagen Allocation Partners. We've had an earnings boom in the United States, so equities don't look quite as expensive as they did on the trailing PE, but unfortunately, price to book is still significantly higher than we'd like to see it. And in our model, which is a valuation to the trend, US stocks are now 40% above their 25-year average. But we still have a fantastic macro support, and it still outshines that of other developed markets. And we still have a good momentum to earnings. Moving on to Europe, valuation looks less pronounced. We have less of a premium on top of the 25-year average, but stocks are not cheap. They're just less expensive. Again, the macro support has helped a lot recently. Earnings support is getting stronger. Earnings revisions are strong. So the macro fundamentals look still very positive for Europe. If you look at emerging markets, the macro support is also getting stronger, and we have support from factors like liquidity, currency, etc. And we see a market which is underpinned by earnings revisions, which are accelerating. But there are some issues with valuation. A lot of people say to me, well, Henrik, the big risk for emerging markets in general is the Fed, because we all know that high levels of foreign currency debt constitute a significant risk. I don't think you can get around that. But this is a way to look at it from sort of a more short-term point of view and see where we're sitting right now. Japanese equities actually look like a value case, paradoxically. We don't really have any excess pricing as far as we can see, but we still have a comparable situation with the rest of the developed markets in terms of earning support. Macro support is relatively solid, and we also have the advantage of a relatively weak Japanese yen for the moment. What about treasuries? Well, the interesting thing is that we have had the spread. You can actually turn the things around and look at treasuries a little bit from the point of view of their relationship to credit rather than the other way around. And what we've seen is, of course, that the spreads of high yield credit has narrowed significantly, and that has prompted more rotations into treasuries. I think particularly from a diversification point of view. Carry roll has improved, but on the negative side is what I would call the fair rate, or what you could call an equilibrium rate longer term, which in our calculation is 2.75%. That's way over where we are now. And of course, we still need the market to pass the test of a sudden change in the Fed stance. I don't think the macro environment looks good for treasuries at the moment, but they are a short-term hedge asset. I think we have to admit that. If you look at high yield, we still, as I said before, we have a very low spread now to treasuries. We've had a good performance driven by the drop in default rates and the drop in US Treasury yields, but the negative carry roll and the level of valuations doesn't really make that asset class attractive going forward. If you take emerging markets debt, we look at, especially at emerging markets in hard currency, the score looks better now because the spread between high yield and emerging markets debt now looks more favorable to emerging markets debt. Macro support looks better for EM currencies, but we still have the same problem with valuation and carry roll that we have for the high yield. And finally, just a comment on value versus growth. I'm sure you follow that. We all expected, I guess, or a lot of us expected a somewhat better performance that we have had when we got towards the late part of 2020. But we didn't really see it to the degree that you might have expected. Firstly, of course, the recovery has been much faster in the United States, very much driven and the market, of course, very much driven by tech, which is a growth stock. But on the other hand, and maybe more importantly, nominal rates have actually not risen the way you might have expected. I clearly confess to being in the club of those who got that wrong. And we even got an increase in inflation, which did not express itself in nominal rates. So we've got real rates which are even further down. Now, I think this is going to change in 2022, but I'll get back to that. Let's see how we're doing for time. Okay, so some asset allocation ideas going forward. Now, as we mentioned in the introduction, a lot of things have speeded up. We had a setback, which is super fast, but we also had a reaction, which was both fast and very powerful. So we end up with a 2020 recession, which is the shortest on record now. We also got high inflation much earlier than we normally do in the cycle. But I do want to point out that two of the factors actually slowed. They were slower than we expected. Fighting COVID-19 has proved a lengthier process than most observers would have expected. And we've had a degree of patience from the central banks, which you may not have predicted. I think we have to weigh off these two factors against each other. Now, what is more risky? Is the growth moderation the biggest risk, or is it inflation? My money is on the last one. If we get some growth moderation now going forward, which looks relatively likely, we'll still probably have growth above potential. So we'll end up with a positive output gap, and we'll start building on that. But this buys time for the central bank. If we crash into phase two with very high growth, it could create some problems. I would rather see a little bit of moderation. So today's GDP readings is actually, from my perspective, good news, not bad news. Now, on the other hand, if we get more increases in inflation and there's really no end in sight, there isn't really a positive reading to that. That is, I think, the biggest macro risk right now. What about Europe? Could Europe pick up? I think it can. Earnings have lagged for the reasons we talked about before, the dominance of tech stocks, the fact that Europe's cyclical recovery has been less pronounced, but I think these things can change going forward. And I think the value side of this makes another argument for Europe, because of course, there's much more value stock participation in Europe, and valuations are less excessive. See, this sort of kicks into the next one, the next question, namely risk management. How do we look at this in the current scenario? Well, I think the key point to make here is that we may very much emphasize that risk assets look expensive, but unfortunately, so are hedge assets. Case in point being government bonds. It's not very clear how much government bonds could do for us if we get a recession at some point or a severe downturn. And if things actually come from the bond market instead, if the direction of causation goes from bonds to stocks, there's not very many places to hide. And I think this points to mitigating risk within risk assets, rather than between risk assets and other assets. There is still some effect left. You can also look at currencies, you can look at some of the commodities, but overall, I think there's a case for trying to mitigate risk more by a regional diversification, as I've argued before. So let me round off with some of the observations that we already made and some of the ideas that that all of this point to, together with my book. When you look at analyses of asset allocation, it's clear that there is a lot to look at. And we should not, of course, turn a blind eye to anything. We have to look at things like liquidity. We have to look at excessive valuations in the short, excessive movements in the short term, dispersion, market positioning. There is a lot to look at. But if we lose track of the cycle, the overall cycle, the big picture, I think we lose out on the biggest part of the analysis. So that's the key message of this speech and of my book. Still, never forget the cycle. Now, cycles are not hard and fast in terms of how long they last. We've seen the pattern of longer expansion cycles in recent decades and very shorter recessions, but this could change. I think we need to assess each cycle. But the good news about the cycles is that they follow a logical pattern which we can analyze. At least we know which are the relevant questions. I think it has to be admitted that COVID-19 distorted a lot of models. I think that includes a lot of quantitative models, but I don't think you should get depressed over this, because when things like that happen, you just have to live with a pause where you use a more qualitative analysis for a while. I think most models have now come back to becoming normal again. And I think the reading of the cycle now does make sense again. And we can make an assessment on that. Another thing I think is relevant to point out, or is at least give an opinion about, is that I don't think the world has changed so significantly that the US no longer sets the pace for global markets. I think we've seen it again and again. America is still the most important market. It's still the most important economy, but of course, a lot of people speculate that with the growth of China could end up setting more of the pace in financial markets. Yeah, maybe, but I don't think we've seen all that much of it yet. So any analysis of any region should always start with the United States and then add, of course, the particulars of that region. Another thing I think is a bit of a trap, which we all fall into, is that we opine too much about central banks. It's tempting because, of course, it's easy not to agree. And you could go back and look, you might already have stopped agreeing many years ago, and you're still critical of what they do. But interesting as that is, from the policy perspective, the policy debate, we have to be careful not to let that guide our asset allocation. We have to focus on likely policy moves rather than wanted policy moves going forward. And a final point is about valuations. Now, everybody points out that the market is very expensive, but I think the key point to make here is that if that were a useful indicator for the short term, valuations probably never would reach extremes. Now, what are they useful for then? Well, they're very useful as a risk indicator, even in the TAA context. And of course, when we talk strategic asset allocation, SAA, that's the biggest variable of all of them. So we certainly shouldn't ignore valuations, but we should use them in the correct way. So on that note, I round off, and I will be happy to take your questions. Thank you very much.
Henrik, you have some questions in the Q&A.
Okay, let me just open that. 1 second. Okay. General consensus was that Wall Street goes back to work in September. About an hour ago, Google and Amazon announced that they're now waiting until mid-October. Some of the Wall Street banks are now reevaluating. How does this second COVID Delta shock fit in with your time frame? I think the key point is kind of what I was hinting at before, that if there's a negative sign in this, and we can get a sort of secondary setback, sure, that's possible. But I think the underlying trend in fighting COVID is still positive. And on the other hand, it does buy some time for the Fed and for the ECB, among other central banks. So it fits in with my framework in the sense that I don't actually mind a little bit of a slowdown. So the positive reading to this nasty Delta variant is that we won't be crashing into the next phase. And I think this will also dampen inflation concerns somewhat. I just spoke to a doctor today who is an expert in microbiology. And he said, well, Henrik, you're not going to get over this. We're not going to get over this COVID thing anytime soon, because it mutates and it's a living being and it defends itself against all the vaccinations. And unfortunately, that's probably true. But at least I think we can get to a much more controlled level going forward. So do we have another question? Let me
Henrik,
see.
it looks like Thomas Fallows has raised his hand. Let me allow him to talk and he can ask you his question.
Yeah,
Hello, I just sent a question about the impact of COVID on the alternative equity segment, because I found your talk very excellent with regard to the broad range of assets of equities versus fixed income, but specifically within the asset class of alternative equities, illiquid assets. What's been the impact of COVID? My impression is that this has been a risk off situation over the last 18 months with regard to illiquid assets, given the COVID situation. But some people argue, no, quite the contrary. This is a investor boom for venture capital with SPACs and high valuations. So what is your view? Has COVID hurt the alternative equity segment, or has it helped it?
I think it's the latter. I think illiquid assets, of course, I always joke with my students that it's easy to manage an illiquid asset portfolio because you don't really have the price of everything all the time. So the pressure from investors gets, more manageable. But jokes aside, I think illiquid assets have come through this much better. It's also part of the reason for that, I think, is the strange relationship we've had between the traditional economy and the new economy, so to speak. I think that is absolutely the case. And I think if going beyond that, alternative assets and alternative asset management, I think, is much more relevant now. One of the big concerns, as I mentioned, is the lack of hedge assets. I think the alternative space gets much more relevant. I think hedge funds are better at seeing possibilities in downturns than most other asset managers, and especially particular complications like liquidity or credit risk or what have you. So to my mind, COVID has not been harmful to the alternative asset space.
Yeah, and so, Henrik, I have a question for you.
Yeah.
So you mentioned, tapering and timing. So with so much cash in the markets, directly in the pockets of consumers, why wouldn't the Fed start tapering soon and then start reversing course and selling off their bond portfolio? Wouldn't that be a natural course of action, and wouldn't that help on the inflationary front? And isn't the timing with so much cash out there, a great opportunity for them?
You might argue that. I think some people still believe in a very clear relationship between the growth in the money supply and inflation. I'm not so sure, frankly. I still think that the old way of looking at it, which is to say, hey, money itself doesn't create inflation. People spending money creates inflation, is the real concern here. Because if you look at what is called the money multiplier, right? How many times the monetary the money supply is turned over, that's extremely low at the moment. So it looks like we have a case of what you call hoarding in economics, hoarding of money. So I'm not really all that concerned about the liquidity issue. But having said that, of course, beginning to reduce liquidity or stopping to add to liquidity as tapering would do, it is the first step towards fighting inflation. But ultimately, I think that the Fed's tools to fight inflation do go around dampening the growth in the economy. And the Fed says it has the tools, but it doesn't really go much further than that. I think the sad news is that if inflation gets very embedded and it gets too stubborn, I think a slowdown, unfortunately, is the only route to lower inflation. And that, of course, would be not just tapering, it would be rate hikes beyond what we see at the moment. I still don't believe in that as the base case. I think that's a tail event as I see it now.
Thank you. Do we have any other questions from the audience? You can either drop them in the Q&A or the chat. Let's give folks a few minutes. So what are your biggest takeaways for the day, Henrik?
My biggest takeaway. Well, I think the paradoxically, I think the cyclical view of the markets and asset allocation in particular is still relevant. It was suspended. I absolutely admit that, and it was very difficult to see any pattern before we got to the fall of 2020. But after that, I think things started getting into place. So then we've got the complication of this early inflation. And there, I think we have to admit that COVID has been a very peculiar factor. It's upset the normal framework to some extent, at least. But I think we'll eventually get a handle on that and understand what is creating inflation and what is not. Because to my mind, it still looks very much like a sum of a lot of micro markets that are creating, that have bottlenecks and cannot function properly. But I don't really see it quite the way we would look at generalized inflation pressures in the past. There is something different about this pattern. Now, however, should we crash into phase two, as I call it, we eliminate all slack capacity and it happens too fast and we start getting inflationary pressures from that, then you could get a secondary outbreak from inflation, which has nothing to do with COVID. That is a risk. Now, rather than guessing about that, I prefer to say, okay, I'm going to look at the figures right now, see what they suggest. They don't look like we're going to crash into phase two yet. And over the next 6 to 12 months, I don't think I don't think the inflation concern is going to get completely out of hand. Another point I've got, of course, to make is that it's not the end of the risk markets because the Fed hikes rates. If earnings are still strong, we still have a strong momentum in the economy, the markets can stomach that. It's less favorable than what we've had in the phase one. I think this scenario we've had now is perhaps the supreme example of a phase one, which has been incredibly bullish. So it's probably less bullish, but it's not bearish as far as I can see.
Fantastic. Well, thank you. I see no other questions at the moment. So a couple points. Henrik, as a former colleague, I thank you for doing this. That was a fantastic presentation. I apologize for the technical difficulties. I experienced some myself in getting in and staying on. And I know Henrik froze a couple times, but we all managed to get through it. And I know we all are much more forgiving these days with the technical problems since we're all experiencing them. One note, Henrik's presentation will be included with the podcast, which will be posted to the website. So keep your eyes out for that. I think it's a great presentation and you should all probably give it a look. And Henrik, as always, great global macro overview. So thanks for that. And then